What a year it has been. When you take a step back and you think of all of the big stories that took place this year, Barrick and Mali, that was a big one. Remember Victoria Gold? Almost felt like last year. I guess soon it will be. Nickel? BYD. I mean, that was arguably one of the biggest economic stories of the year. I don't know if you're going to see it on, your top 10 lists across, the internet, but I would say the coming out party, so to speak, of BYD was kind of massive. And hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. Happy New Year. It is New Year's Eve here. It is the final day, the final show of 2024. And again, what a year. Deep sea mining. Remember how they elected a new International Seabed Authority Secretary General, Leticia Carvalho. So deep sea mining came back. It was a huge story this year. We had uranium miners kicked out of West Africa. We had Resolute Mining CEO Terry Holohan detained, but from the second last Barrick press release, it sounded like Terry Holohan and two executives were actually jailed for over a week, sounds like almost 2 weeks, in Mali. We had an arrest warrant for Mark Bristow. Arguably one of the biggest stories of the year. In terms of sensation, I'm actually quite proud of what we did here on this podcast. And for those that have been listening, you'll remember it was kind of a big deal over here because I believe it was in April, I found this story on the Africa Report that Wagner Group wanted to expropriate the Mali mine. I said, this is very sensational, but let's take a look at this narrative. And we had that narrative for a good, let's call it 3 weeks minimum, before the Globe and Mail started to report on it, at least here in Canada. Like, I'd argue we were the first Western media to discuss what became one of the biggest stories of the year. Now, the Africa Report, of course, broke that story. And, of course, that was a story of rumor, and I qualified it as such at the time. But ultimately, what we've seen is that was really the beginning of what became one of the biggest stories of the year in the mining sector. This situation in Mali with, Barrick and the Loulo-Gounkoto mine. And in a weird way, it never turned out that Wagner expropriated the mine, as we've learned over the course of the year. But as we saw in some of the most recent articles, the analysts are saying part of the reason this is happening, why Mali is all of a sudden shaking down miners for money, seemingly, is they have to pay Wagner, right? So in a weird way, we were, as we do when you're early, we were piecing the narrative together. It wasn't uncredible what we did. In fact, it was quite credible, actually, how it all turned out. So there's Barrick and Mali. Another story we covered here was Victoria Gold and the whole, debacle that followed the Tails Dam failure, as it was called, where we saw very little being done really by the government or the company. If people at the company were doing things, they didn't communicate it. It was something like every 3 weeks they're putting out an update while, concerns grew that the land was being contaminated, where some people live off of that land. So that was another huge story. Going earlier in the year, this nickel story actually was a gigantic story. One could argue the nickel story is a facet of the BYD story that was not really discussed that much by, your traditional media. But at the end of the day, my thesis remains here. Why can GM produce an $8,000 car in China and not in the United States? It seems to me that it's pretty clear that it's the supply chain. And what is it about the supply chain that enables China to do this? Sure, they have good manufacturing, probably cheaper labor, but at the end of the day, the seemingly insurmountable lead that they have is really the domination of metals processing, particularly of the battery metals. We had Volkswagen, or as they say in Germany, Volkswagen, closing down plants, and there are many reasons for this, but at the end of the day, they simply can't compete on costs. It comes back almost to this, classic expression, in the gold market, the person who has the gold makes the rules, right? And another way of framing that is the person that runs the metals supply chain makes the rules. And at the end of the day, what made Walmart so successful? What made Amazon so successful? Price is king. As Walmart says, why pay more? Ultimately, if you're getting an equivalent product at a lower price, what are you going to do? Why pay more? That is the story, I would argue, of BYD this year. They have the cheap nickel, they're producing the copper, they have the rare earths, and that's not to mention the graphite. They are stockpiling cobalt, and let's not even forget the germanium, gallium, and antimony. Another huge story. We've been waiting really for years for China to act with the United States in regard to cutting off the mineral supply. This has been a fear, I would argue, at least since China cut off Japan temporarily from rare earths, and I believe it was 2010, sparking a massive bull run in the rare earths. So again, we have export controls. We have Myanmar. We have the Democratic Republic of Congo. We have Mexico, where they had an election, and strong, pushback on open pit mining, of all things. And there are also what we might say continuing narratives from the years prior. Green metals, in particular. Remember when nickel crashed, you had Andrew Forrest of Wailu Metals come out and say, we need a green metal price. And we've had people on the show, Teo Yamaogo, I've discussed this with Rick Rule, I've passed this off on several people. It's not going to be easy to implement. Again, we're kind of back to Walmart, why pay more? Actually brings up a whole other issue, which is where is this metals bull market? We have gold completely breaking its record. That was another huge story. We have record gold buying from the People's Bank of China. And we have a supposed bull market which has still not materialized in the metals. Nickel is below $7 still, $6.99, right? Copper looking like it wants to drop below $4 again. $4.03 a pound on CNBC here. Silver back below $30. So other than gold, and maybe, antimony and germanium and gallium and maybe a few other obscure, so to speak, for lack of a better term, metals, this bull market is yet to appear. And right now, the industrial metals seem to be suggesting that we're at least going to head for a bit of a pullback here, interestingly, or at least that there are fears as the metals lower in price. Look at lithium. I mean, where are we at on lithium? We're almost below $10, $10.28 per kilogram. Cobalt, $11.02. And so when you step back and look at our year of stories, it seems quite interesting how they almost all seem to relate, like a big web of story that is saying the global economy is changing, that the metals are a key component in this. We've seen an increase in resource nationalism, a story that we looked at in the last couple of weeks that Cecilia Jamasmy, editor-in-chief of mining.com, wrote. We see also heightened geopolitical tensions, as we see by the export ban on germanium, gallium, and antimony by China, that this could have defense-like implications. We saw a recent investment by the Pentagon in a Canadian mining company. So almost as we take a final step back here on the year, what's super interesting, I mentioned it last episode, we can see the natural resources narrative as you might say, a elemental or fundamental layer of the news narrative. And what's particularly interesting about it is you could see it as quite a lower foundation. It's not just elemental, one might say, to the news narrative and a crucial component. You might say it's one of the foundational components of the news narrative. When you look at the stories of the year, wars in Europe, we had Lindsey Graham, talking about the rare earths that need to be secured in Ukraine, and that's a major reason why NATO and the Ukraine has to triumph. right? We have Myanmar. So much can be explained and understood by paying attention to the resource sector. And what's interesting is how little attention it gets. It's gotten more in the last, let's say, 2 to 3 years, even 4 years, let's call it since COVID, where all of a sudden supply chains became highlighted as an issue of importance in the global economy. But even still, we see the words supply chain used. But oftentimes I feel like these words are used, but the reality of what those words actually entail is not always transmitted in the meaning of those words. It's almost like for all of the chatter that is occurring within the news media and the entire global news narrative, the counterpoint to these words, not the only one, but one of the fundamental one, are natural resources. These irreducible elements, foundational elements, one could argue, of the global economy. In the case of gold, one could argue of the financial system. Maybe that's more debatable. So just some reflections here as we take a look back at quite a year. And finally, I can't leave without talking about what's happening technologically in the mining industry. And we've covered it with a few, companies really that are trying to do things that are helping automate the mine, which we've learned on this program seems to be a combination of sensors to gather data, AI that processes that data, as well as robots that move around on their own and basically perhaps are controlled by the AI or perhaps someone in the control room outside of the mine. This is increasingly becoming the model of the modern mine, as we learned this year. So quite a year to be in the news business, particularly on this beat, which again is not over-covered here. It's not like talking about U.S. politics where it's just endlessly discussed, in a billion different places. There are many places to go for natural resources, but it's not quite as many, right? And for that, I'm very grateful because it remains and is increasingly one of the most exciting and interesting areas of the global news narrative, a foundational layer of information that is crucial, I would argue, to understanding many of the biggest stories that exist. So with that, I'd like to wish you a happy new year. A big shout out to everybody listening on a New Year's Eve or a New Year's Day and supporting this program. You have been wonderful, and I appreciate all of the positive feedback I've gotten online and in person. It means a lot. So with that, we have a wonderful show. I thought we could put the interview I did with Rick Rule at the International Mining Symposium, the Investor Breakfast, on a Sunday morning, a packed room, where I talked to Rick Rule about the reasons why he invests in natural resources, say over the S&P 500, and some of the more challenging issues of, really what it takes to be a great investor and speculator in the natural resources business. So I hope you enjoy that. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to the news. Turning to the website, supply shortage looms for critical battery raw materials by 2030, according to a report by McKinsey. This is by a staff writer at northernminer.com. Vehicle and battery makers are, quote, likely to confront persistent long-term challenges, end quote, in keeping up with demand by the end of the decade, according to a new report by McKinsey & Company. Ensuring a reliable supply of critical battery raw materials will be crucial to the global push to net zero, especially with demand for battery electric vehicles picking up within 5 years, the consultancy says. Worldwide demand for BEV passenger cars is to grow sixfold from 2021 through 2030, with annual unit sales increasing to roughly 28 million from 4.5 million during that period, McKinsey estimates. Demand will outpace base case supply for certain materials, requiring additional investment and threatening shortages and price volatility, among other challenges, it said. In particular, its report highlights that automotive original equipment manufacturers are giving more attention to reducing Scope 3 emissions, greenhouse gases released outside of an organization's direct control, but that the organization indirectly affects, from material usage. They contribute a large portion of what batteries emit, so battery materials sourcing has become ever more important for battery producers. Based on the current market, battery manufacturers can expect challenges securing the supply of several essential raw materials, such as lithium, high-grade nickel, cobalt, and manganese. Battery makers use more than 80% of all lithium that is mined today, and that could grow to 95% by 2030. With technological advancement shifting in favor of lithium-heavy batteries, lithium mining will need to increase substantially to meet 2030 demand, McKinsey says. For nickel, fears of a shortage prompted by the shift to BEVs, or battery electric vehicles, have already triggered significant investments in new mines, particularly in Southeast Asia, but even more supply will need to be brought online. McKinsey's report suggests the possibility of a slight shortage in 2030 as the battery sector continues to vie with steel and other sectors for Class 1 nickel. While the share of cobalt in battery chemistry mix is expected to decrease, the absolute demand for cobalt for all applications could rise by 7.5% per year from 2023 to 2030. McKinsey estimates, adding that shortages of cobalt are unlikely, but its supply will be driven by nickel and copper since it is largely a byproduct of their production. Meanwhile, the supply of manganese is projected to grow moderately through 2030, but an increasing demand for battery-grade material is likely to outpace supply, requiring the development of new refineries. And scrolling down a bit, moreover, although supply concentration for materials such as refined nickel, cobalt, and lithium are knowable, complete visibility into the origins of raw materials is sometimes unattainable. This is the case with high-purity manganese, of which more than 95% is produced in China, and minor volumes come from Belgium and Japan. Graphite, of which almost all is refined in China, and anode production, on which China has a near monopoly. Limited transparency into the origins of battery raw materials supply also poses broader environmental, social, and governmental concerns and attention. For instance, EU batteries regulation aims to make them sustainable through their entire life cycle, from material sourcing to battery collection, recycling, and repurposing. As a result, McKinsey believes the pressure to address ESG concerns will likely increase. So, interesting counterpoint to the price action of battery metals this year. Continuing on, Mongolia reaches deal for $1.6 billion uranium mine with Orano. This is Reuters via mining.com. Mongolia said on Friday it had reached a preliminary agreement with France's Orano Mining Group to develop a long-expected uranium mining project worth $1.6 billion. A draft agreement for the deal was submitted to the Mongolian parliament for preliminary discussion, the Mongolian government said. The project, with an initial investment of $500 million and a total investment of $1.6 billion, will start its preparatory phase from 2024 to 2027, with first production expected in 2028, the government said. And we have a quote from Mongolian Prime Minister Oyen Erdene Luv Sanam Srai, who said, quote, "This agreement is a significant step forward in boosting inward investment and employment opportunities for the Mongolian people." End quote. You wonder if Orano, with all the trouble that they had in Niger, is shifting their focus to Mongolia. Continuing on, Cassius Mining takes Ghana to court for $277 million. This is by a staff writer at northernminer.com. Cassius Mining is taking Ghana to court in London seeking $277 million in damages for alleged contract breaches that killed the company's G-Bane gold project and may involve a Chinese company. The Australian miners' claim, witness statements, and independent expert reports have all been filed at the London Court for International Arbitration, a panel for disputes between companies and countries, according to a December 23rd release. Well, Barrick started the trend, didn't they? And now everybody's realizing that they do have options if they do have disagreements with the government. Cassius said in a statement, quote, "Ghana's actions, including its failure to renew Cassius's prospecting license, has resulted in Cassius being deprived of the entire value and profits of its gold project in Ghana." End quote. The claim amount represents, quote, lost profits and damages for the loss of opportunity to develop, establish, and benefit from a producing gold mine in its licensed area, end quote, Cassius said. Continuing on, China's November net gold imports via Hong Kong hit 7-month high. This is Reuters via mining.com. China's net gold imports via Hong Kong in November more than doubled from October, marking the highest level in 7 months. Hong Kong Census and Statistics Department's data showed on Monday. The world's top gold consumer imported a net 33 metric tons in November, up 115% from 15.4 tons in October, its highest level since April 2024. Total gold imports via Hong Kong were up 60% at 45 metric tons from October, posting its highest level in 8 months. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.52%. That is down 0.09% from last week. But U.S. 10-year bonds still above 4.5%. The U.K. 10-year gilt is at 4.57%. That is down 0.03% from last week. Italy's 10-year bond is yielding 3.52%. That is 0.02% higher than last week. The German 10-year Bund is yielding 2.36%. That is 0.03% higher than last week. And the Japanese 10-year bond is yielding 1.08%. That is 0.01% higher than last week. So US and UK yields drop, while Italy, Germany, and Japan yields edge higher. Turning to precious metals, gold is trading at $2,627.20 per ounce. That is $2 lower than last week. Silver is trading at $29.29 per ounce. That is $1 lower than last week. Platinum is trading at $902.80 per ounce. That is $43 lower than last week. And palladium is trading at $883.50 per ounce. That is $39 lower than last week. Turning to industrial metals, copper is trading at $4.05 per pound. That is 2 cents higher than last week. Iron ore is almost unchanged at $103.90 per metric ton. That is 6 cents higher than last week. Aluminum is trading at $1.16 per pound. That is a penny higher than last week. Lead is slightly lower at 88 cents per pound. That is 3 cents lower than last week. Nickel is slightly higher at $6.99 per pound. That is 4 cents higher than last week, but still below $7. Tin is trading at $13.06 per pound. That is 5 cents higher than last week. Cobalt is unchanged at $11.02 per pound. Lithium is slightly lower at $10.28 per kilogram. That is 7 cents lower than last week. Uranium is at $70.35 per pound. That is $3 lower than last week. And finally, zinc is a penny higher at $1.37 per pound. That is a penny higher than last week. Overall, precious metals edge lower, while industrial metals edge sideways. So perhaps not too much action during the holidays is a real takeaway here. And those are your metal prices. Coming up, I'm very pleased to share with you my interview I did with Rick Rule at the International Mining Symposium for the Investor Breakfast. It was a fascinating discussion. It is an in-depth interview on how Rick sees the markets, why he prefers natural resources to other sectors, and the importance of understanding investor psychology and how it applies to investing in the real world. I hope you enjoy it, and I will see you on the other side. So I think most of you know who Rick Rule is, but for just a couple of lines here, for those that don't, I was surprised to learn he began his career in 1974, and I was thinking we could do a whole hour just on 1974. in the securities business and has been involved ever since. He is known for his expertise in many resource sectors, including agriculture, alternative energy, forestry, oil, mining, and water. So, Rick, welcome to the International Mining Symposium. It's thrilling to have you here to open everything up.
Well, it's a pleasure to be here. I was laughing. In 1974, I was a Northern Miner reader, so it's amusing after 50 years to be at a Northern Miner conference. I've enjoyed the publication. I'm embarrassed to say for as long as you've been on Earth. It's been a wonderful publication. It's been a wonderful life.
Well, it's great, and it's awesome that you mention that every time I talk to you in public. So, no, but I appreciate it. It's deeply appreciated. And I meant the part about the Northern Miner, by the way. So the first thing I wanted to open with, I think a lot, I've heard you speak a fair amount over the years. And so maybe other people have too. So I was wondering, what is it about the resource sector that attracts you? Is it the cyclicality? Is it the sentiment shifts in the resource sector that in some ways maybe make it easier than the S&P 500, perhaps? What is it about resources that attracts you as an investor and speculator?
Well, initially it was foolishness. As a young man, I liked to be out of doors. My stepfather was a biologist, and I thought that a career that would take me outdoors would be something that I aspired to. The consequence of that is that I've been stuck in an office for 50 years doing finance. After I cut my teeth in resources, then there is a predictability around capital-intensive cyclical industries. And I learned myself that while a contrarian is often early, a contrarian over time is seldom wrong. And I learned after some really, truly ugly initial mistakes that I hope we don't dwell on, that questions that begin with when are better than questions that begin with if. And in resources, as an example, if a commodity is priced on a global basis less than the cost of production, there's only two outcomes. The world can run out of that resource, or the price goes up. And there's a certainty to that, which appeals to me.
That's exactly kind of what I sort of, maybe that attracts a lot of us to the resource sector at the end of the day, is that sense of, there's an inherent value here. And as you put it, in a sense, and just to follow up on the previous question, do you find it easier then, to a certain degree, and if that's a fair term way of describing it, than say the S&P 500, why not the S&P?
There was a point in time in my young career where I had been successful in resources, and I thought the consequence of that is that I was a successful investor, and I could be across all sectors. Sadly, I proved that that wasn't the case, and I decided to focus on areas where I had deeper experience and deeper contacts, which is resources. I was born and raised in what is now Silicon Valley in California, and had a sort of an early exposure to technology. And technology for me was hopelessly complex. All of the questions that were asked in technology, not unlike exploration, are questions where the answer begin with if, not when. And I found myself looking at businesses, frankly, Adrian, that I couldn't pronounce. And the idea that I was going to be able to outcompete all of those incredibly brilliant, incredibly forward-looking people in industries that I couldn't even pronounce seemed very difficult. I can pronounce coal. I can pronounce gold. If pushed, I can pronounce brick. But the industries that I was exposed to as a very young man in Silicon Valley, and even later, many of you know Paul Stevens, the Stevens of Robertson Stevens. I do business with him today. And I'm fascinated listening to him talk, and I'm absolutely delighted that I don't have to compete with him in terms of other businesses. So I've, for the last 30 years, in addition to investing in natural resources, I've invested in conventional financial services. So banking, wealth management, asset management, insurance, because I built a couple financial services businesses and resources, and I think I'm reasonably competent. But I have absolutely no interest in trying to compete with people who are smarter than me in industries I know less about than they.
Excellent. So we just had this election in the United States of Donald Trump. He was reelected. And how do you think that changes the investment landscape for resource investors? Or does it make a difference at the end of the day at all? In a sense, are the fundamentals, and it doesn't really matter who's going to get elected, we still need the copper. So how do U.S. politics factor into your investment strategy?
I think the truth is in the middle. I think for the remnants of the American mining industry, that some of the regulatory burden will lessen. I think for the Canadian oil and gas industry, it's going to be a wonderful circumstance. The Canadian Prime Minister doesn't think there's a business case for Canadian natural gas, but the rest of the world thinks so. And if Canada can't get the gas out to the east, they can get out to the southeast through the US. I think that'll be very helpful. I don't believe that Mr. Trump will address America's real problems. If you read his book, The Art of the Deal, Mr. Trump seems to me to be extremely transactional. And he approaches business in a very different way. By the way, I didn't like who he was running against either. He views transactions as win-lose, a winner-take-all circumstance, as opposed to a transaction where a transaction takes place because both sides win. The idea that somebody could read The Art of the Deal and vote for him is a mystery to me, explained away probably by the fact that not very many people who voted red. The real issues that I see in the United States and Canada as well, and I don't know the Canadian numbers or the British numbers for that matter, but the American numbers are that our on-balance sheet obligations exceed $36 trillion. If you write that number down, that's 12 zeros before the other bit. And even more problematic, I think, is that the net present value of unfunded entitlements in the US, old guys, Medicare, Medicaid, Social Security, that number, not according to some cranky fat libertarian, but rather according to the Congressional Budget Office, exceeds $100 trillion. Putting those two numbers into perspective, which President Trump doesn't seem to want to do, the accretion of on-balance sheet and off-balance sheet liabilities in the United States exceeds federal gross revenues every year. If I were to issue a bond and I made the type of disclosure that would be required privately, let's put it differently. Selling U.S. Treasury securities without a disclosure of the balance sheet risk of the United States seems to me to be securities fraud. And Mr. Trump and Ms. Harris seem to be completely willing, from my viewpoint, to commit securities fraud on a daily basis, which is problematic, I think, for the United States and for the world. Sorry for that long-winded answer, but I care about that question.
Yeah, and I feel like we're just getting started on it to a certain degree, in the sense that, so there are all these, unfunded liabilities. So how does this, does it factor in when you're kind of assessing, again, resources, which is part of the reason we're here, as an investment, renowned speculator as you are, how does, say, these unfunded liabilities do they factor in, or is this sort of more of an abstraction that a cloud hanging over your decisions, so to speak?
In the gold part of the trade, in the precious metals part of the trade, it absolutely factors in. I don't think that there's the political will in the United States to rein in Medicare, Medicaid, Social Security, federal pensions, military pensions. Given that we can't afford them, and we won't do without them, it seems to me personally that the most likely outcome will be to do what we did in the decade of the 1970s, where you reduce the purchasing power of the currency to the extent that you inflate away the net present value of the obligation. Meaning that some old geezer like me who gets whatever I get from Social Security, $4,000, whatever, I don't know what it is, It's likely that I keep getting it. But $4,000, I think 10 years from now, probably buys me $800 worth of goods and services. I think we keep intact the nominal level of entitlement, but we inflate away the net present value. Again, according to the US government, in the decade of the 1970s, the United States dollar lost 75% of its purchasing power over the course of the decade. Not coincidentally, the gold price went from admittedly price-controlled $35 to $850. And I suspect that happens again. Does it have to happen? No, I don't think there are many certainties in life. But it seems to me like a probability. A probability because I'm not smart enough to figure out any alternative.
It's a great point, and that's kind of exactly where I wanted to go with the 1970s, which is, since you started in 1974 and discussing the 70s, in a sense, do you think that was an easier market, so to speak, to invest in as a resource speculator compared to today? Or is it more challenging in terms of, 2 or 3 decades ago?
Well, it's easier for me now because I've done it for 50 years. In a sense, dealing with a hyper-bull market was easier for me then because I was young and dumb. And in a hyper-bull market, it actually helps until the very end. If you don't overstay, you're welcome to be young and dumb. Narrative as opposed to arithmetic runs the market. I'll have a happier ending this time. Because there will come a point, I think, where the popular press, where the popular narrative is all about stuff like gold. And when that happens, I think I'm old enough and experienced enough, if rigor mortis doesn't get me first, to affect my exit.
And just to follow up on that, would you say that's one of the hardest things to learn, is when to exit?
It's very hard. Yeah, it's very, very hard. Going back to the decade of the 1970s, I made for what, as a young man, a really, truly lovely amount of money. And I, despite the fact that the oil price went from $2.50 to $30, and the gold price went from $30 to $800, the silver price went from $1.50 to $50, I inexplicably thought that I was making money because I was smart, not understanding the fact that the wind was at my tail. In 1982, when commodity prices crashed, I found out just how smart I was, which is to say, not very. I went from being a very wealthy, hubris-ridden young man to having a net worth below zero and a self-image to match. And I decided at that point in time that there was no necessity to repeat that trick. I learned that markets truly work. That the cure for high prices is always high prices, and the cure for low prices is always low prices. Later on, I learned that most of my competition gets it exactly wrong. Most of my competition doesn't believe the narrative until the price action has validated the narrative. Trying to get people here 4 years ago to buy uranium at $30 a pound, when the industry average production cost was 60, was very difficult. They got the narrative, but uranium hadn't worked for 5 years or 6 years. It had fallen, all that kind of stuff. When the uranium price cruised through 100, then the narrative became self-evident to people because the price action had justified the narrative. The problem is that the price didn't have to go up anymore. So when people came around to understand the fact, there was no value left in that fact. And I suspect that whatever success I've had in natural resources has come from simply observing that fact. You have to be a contrarian or you're going to be a victim. And if you don't have the courage to buy when something has to go up, and you don't have the foresight to sell when it doesn't have to go up, you're not going to do well. Maybe you're going to do well, but you need a different skill set. You need a journalist skill set. You need to understand perhaps the value of a narrative on a market, or you need a trader's skill set, neither of which I have.
It's interesting. And so in a sense, like the delusion of like what you might call the early investor, or you in the 70s, or many of us, was that this thing was going to go up forever, right? And that ultimately your lesson at the end of the day is this is cyclical, and no matter how brilliant you are, this thing is going to go down at some point. It's just like it'll go up at some point. Is that fair?
So true. So true. The popular belief when a narrative was working is that markets don't work. I remember very well in the decade of the 70s that if you polled all the big thinkers in the world, the Wall Street Journal, the World Bank, I use big thinkers, of course, sarcastically, our government, your government, a consensus probably was, well, you may not remember the Club of Rome, but that was a special group of morons, the sort of predecessor to, anyway. And they basically said that the oil price was going to $250 and that the gold price wasn't going to go, up. It was going to go through the roof, and that we were going to run out of food, and there was going to be mass starvation, and all this kind of stuff. They took a trend in motion, ad infinitum, ad nauseum. And that's not the way markets work. And that was a valuable lesson to me. And the fact that many of my competitors seem never to have learned it is a real benefit to me.
Yeah, no, hilarious. Yeah, Club of Rome, only scrolling X and coming across Alex Jones' feed, and maybe there's Club of Rome. So then bringing it back then to where we are now. So with all of this in mind, all this groundwork, so to speak, in the current commodities cycle, no one knows exactly where we are, but what is your sense of things? I mean, it does seem like we're not on a bottom here, but I guess it depends on the metal you choose. I mean, uranium is up, but copper's not on a bottom. I mean, how do you see where we are right now then?
We're in an interesting place, I think. I think that we have underinvested, not for 5 years, but rather for 30 years, in the supply of industrial materials. And I think on a supply side, that's going to challenge us, really, truly challenge us. What could derail it? Well, that's pretty easy, a recession or a depression. You can have supply constraints if you reduce demand and price still doesn't go anywhere. I'm not an economist particularly, so I don't want to make predictions around that. But I have no trouble understanding the fact that as a society we have underinvested and misinvested in exploration development on a global basis for a very long time. At the same time, there are increasing geopolitical tensions. So, as an example, other power blocks, the East, are trying to do what the United States did in the 1960s. They're trying to secure politically their access to materials, which I think exacerbate that problem. So one, I think, can feel good about a range of industrial materials. I think, as I said earlier, for the reasons I said earlier, if you have a 5-year or 6-year time frame, I say unfortunately, but unfortunately, I think the gold price does very well. I say unfortunately because the set of circumstances that causes the gold price to do well is normally upsetting. I have a good life. I just assume it didn't change. I tend, there's a great phrase, there's always a bull market somewhere. Given my outlook, I tend to smile at the phrase, there's always a bear market somewhere. So I try to look for materials that are out of favor with obvious warts. Or better yet, when I can find them, a material that's hated. Buffett says you buy straw hat in winter. So as an example, I'm starting to learn what I can on a global basis about sulfide nickel deposits right now. The market hates them. They're shutting down production on a global basis. There's no better indication of hate than people taking billion-dollar write-offs and laying off staff and stuff like that. I'm attracted for the same reason to platinum group metals. I think, but don't know, that we're going to have a washout of epic proportion in the lithium equities. I may be wrong. It may be the spate of takeovers. The rising tide floats all ships. The point is that my own discipline involves finding commodities that meet my broad themes, but ones where, if possible, the selling price on a global basis is less than the global aggregate cost of production. Industries that are literally in liquidation, where if you dial yourself, as an example, back to 2020 or 2021, with COVID and the modern equivalent of the Club of Rome, the oil prices worldwide briefly went below zero before they evened out at $20. If you apply my discipline, you ask yourself a question. Will the price of oil go up so that the industry covers its cost of capital, meaning $60 US, or will your car not start? Those are the two choices. There's no intermediate choice. I love circumstances where industries, where the product is necessary for the material well-being of humankind, where that commodity is priced at a discount to its cost of production. That means I'm always early, always. Sometimes, if I'm too early, if you're 5 or 6 years early to 8% discount, you're not early, you're wrong on a net present value basis. But still, I try, Adrian, to ask myself questions where I think the answer begins with when, not if. So those are the types of circumstances I'm attracted to. I can be less challenging in front of this crowd because although the gold price is moving up, I think the gold narrative is so intact that I can risk being popular in that commodity.
Right. So, and it does bring us back to the beginning of our conversation with certainty, as you say, a when, not if.
Right.
And so, in terms of, sentiment, you've alluded to, there's fundamentals, there's narrative.
Right.
In a sense, do you have a system, so to speak, as you're kind of deciding on, or is it it's sort of a constellation of circumstance that, okay, they're laying off nickel's below the cost, and this kind of do you have a system?
It's really arithmetic.
Right.
I'm not good at narrative. I hate to keep making fun of myself, but I can't dress myself. I don't own a television set. So the idea that I can anticipate popular culture, the probability that I can compete in understanding the impact of a narrative on a crowd is not in my skill set. It's no good. But I'm good at arithmetic. My education was really in credit analysis. And I really, really, really like, when I say big data, I don't mean things that require a whole bunch of machines. When I say big data, I mean like obvious data. When I look, as an example, at the fact that precious metals and precious metals securities enjoy, if that's the right phrase, a 0.5% market share in the United States among savings and investment assets, with a 4-decade mean market share of 2%, that tells me, if I'm right about the inevitability of the decline of purchasing power in the US dollar, that all the precious metals prices need to do, all the market share needs to do is revert to mean for demand to increase fourfold. That's what I call big math. You have an infinitesimal market share now. And I don't need this old gold bug thing about gold's going to blow up the US Treasury market, or gold's going to replace the US dollar, or any of that BS. All I need is for the market share of precious metals and precious metals securities to revert to the 4-decade mean. And I have a 4-fold increase in demand. That's what I call big math.
Right, so that almost sounds like fundamentals a little bit, right?
If you're a credit analyst, it's all fundamentals.
Right.
The narrative is not collateral.
Right, narrative is not collateral. I love that. And just as you say then, because I'm almost surprised to hear, it's like, hey, you're cool with the gold still. And it's based on these fundamentals maybe of debt and wider deficits, which we discussed earlier, right? Super interesting. Okay, so then for the general investor then, how are you, how should they approach this market? Because of course, generally speaking, when you look at gold and silver stocks, it's kind of a stock picker's sort of game, one could argue. But for, who's to say that you shouldn't just get GDX or GDXJ, despite whatever fundamentals are within the ETFs and the companies within those ETFs? In terms of result, what do you think the general investor should do?
My view there is nuanced. Partially, I'm conflicted. I'm still the largest shareholder of Sprott, and at Sprott we issue ETFs. So the greedy part of me says buy ETFs, preferably ones issued by Sprott. A different part of me says that I pay a fee to own an index of 40 stocks, 20 or 25 of which I wouldn't own with a straight face. The idea that I pay a fee to own a bunch of stocks that I wouldn't otherwise own seems inelegant to me. What I would tell most investors, probably not the investors here who work hard, they come out on Sunday morning to learn about resource stocks, but for most investors, what you find is that an extractive industry bull market is such a profound financial event that you don't have to go for alpha. You don't need to look to outperform the resource market. You just need to buy beta. You need to buy the extent to which resource markets outperform other markets. And I think what you need to do there is deconstruct the indexes to find the best companies, the companies with the best pipelines, the companies with the most conservative balance sheets. You don't need to outperform the market, because in a gold bull market, the best of the best give you 200 or 300% gains over 3 or 4 years. There are some people, myself when I was younger, who are terminally greedy. 200 or 300% gain seems somehow insufficient. And it's fine to look for alpha, but looking for alpha means taking risk, and it means working really, really, really hard. I think most investors would prefer to read books, hang out with their kids and grandkids, go on vacation, fish, not work the 60 or 70-hour weeks that I did decade after decade after decade. For them, buying the very finest companies in the sector, preferably unbundled from an ETF, which in movie parlance is the good, the bad, and the ugly, all rolled into one. Even if you underperform the index, but you de-risk it by buying the best companies, is probably the most sensible approach.
Interesting. So then, in a sense, you're saying create your own ETF to a certain degree if you have the time.
Much smaller.
But much smaller.
Yeah,
so
much smaller. De-risk the ETF. The ETFs, they're all things for all people. You get optionality, you get everything in there. And my preference, I think, now for most generalist investors, if I was still in the broking business, I would say buy the best of the best. Perhaps you get a 260% return as opposed to a 310% return. But you do it by taking out the operating risk. By buying the best of the best. Ironically, you underperform the index in a rip-roaring bull market because the inefficient companies have more leverage to the commodity price. But you do it by taking away most of the risk. You can, now that I'm an old man, you can take away some of my upside if you take away most of my downside.
This, and in a sense, this relates to what we were saying earlier about it's harder to sell, as they say. And in a sense, you're saying, I don't mind making less money if my risk is lower. And by putting in high-quality companies, or that I determine high quality over an ETF, which might have all sorts of, it's better because I'll have less risk.
Understanding that for myself, it amuses me, if nothing else, to chase alpha. This is very much a circumstance where it's do as I say as opposed necessarily to all of what I do. Because I really, really, really enjoy security analysis around juniors, and I've learned how, at least relative to other speculators, to outcompete many of them.
Excellent. So, which brings us, you mentioned the explorers, the large cap versus the small cap companies. How do you approach that, or how should, let's say, how should the investor approach a large cap versus small cap in terms of, how much are you allocating? Because in a sense, it's a different kind of risk now you're taking, I suppose, right? This isn't the same kind of risk, but it's a different kind.
It is. I would suggest that an investor shouldn't go near the small caps. I define as an investor as someone who allocates capital with the reasonable expectation of a reasonable return on capital employed. I would regard the speculator is somebody who is willing to accept the probability of a loss on any individual decision in hopes of making outsized gains in enough stocks that the successes amortize the failure. And I would suggest that a speculator, in order to be successful, perhaps because they take more risk, has to be willing to do a lot more work. I've graded now, many people don't know this, but I grade anybody's portfolio who wants for free. And I've learned an awful lot grading tens of thousands of portfolios. Germane to this conversation, two things. The first is that most investors don't understand themselves. If you ask them to describe themselves, they say they're conservative investors, when in fact they're wild-ass speculators. I've noticed that. The second thing is that most speculators own many too many stocks. I ask people to own the number of stocks that corresponds to the numbers of hours per month they're willing to spend studying their portfolios. And I don't mean listening to your podcasts or mine. I mean reading insider reports, reading resource evaluations, reading proxies, reading annual reports, reading quarterly reports. What I find is that it's not uncommon for a speculator, first of all, to describe him or herself as an investor, which is wrong, but also to own 50 or 60 names, and on questioning, find out that they're willing to spend 2 or 3 hours per month doing the work. That almost certainly guarantees a loss.
Fascinating. So, as you say, to summarize, this is speculation. This is not investing. The investor should not be buying junior companies, but if you want to speculate, this is the realm of the speculator.
Right.
And so, and just kind of quick follow-up on that then. So, as you say, conveniently, how many hours are you willing to put in? So I guess that answers itself, because I think the general investor still wants to, in a sense, you buy junior exploration stocks.
I do.
And
I do two things. I failed retirement completely. Let's get that out of the way. So I work at it pretty hard, and I really enjoy it. But the second thing I do is I spend a lot of money hiring people to do work for me. Consulting geologists, consulting engineers, financial analysts. So if you look at the total number of hours that I both spend and cause to be spent per month, I'm probably more like 4.5 hours per month, per name.
Per day or per month?
Per name.
Oh, per name.
So
gotcha.
Rather than spending an hour per name per month, I'm probably spending 4.5 or 5 hours per name. I'm not spending all of it, but I spend a lot of money on consulting geologists, consulting engineers, financial analysts, that kind of thing.
Okay, excellent. So kind of switching gears a little bit, here we are in London. And so I'm kind of curious, it's a major financial hub. How do you view London's role in resource investing compared to centers like, say, New York or even Toronto?
I've learned a lot in London, and I like the investment community here. I like it in particular because the investment community here is probably the least ethnocentric investment community in the world. If you deal with the brokers in Toronto, they tend to believe in Canadian names. There tends to be a belief in Toronto that Canadian gold, preferably Ontario gold, is more valuable than gold other places, which objectively isn't true. Great Britain doesn't produce much. And so the British investor has always been more comfortable in Africa, in South America, in Australasia, in Russia. The London investor, perhaps with the exception now of the Chinese investor, is the least ethnocentric investor on the planet. The one that has probably the most jaundiced, or put differently, the most accurate view of political risk. So I enjoy London as a financial center. I could criticize securities laws here if you want, but there's no real sense insulting our hosts.
Okay, excellent. Indeed. Okay, and I'm kind of curious as well about, like, is AI factoring into your workflow at all? And just in a larger sense, I mean, again, we're seeing since 1974, you've been involved in this business. I mean, how have you seen the change in IT technology evolve over, your career, and kind of, is AI factoring into that at all?
With the caveat that my track record around technology is unblemished by success, I'm trying to understand more about AI and machine learning. The only breakthroughs that I've made so far, I've made none with regards to AI in finance. Hopefully younger and smarter people will help me with that. AI has a lot of application to what you and I do. AI can listen to our podcasts and annotate them. When I used to annotate my podcasts, a podcast would take half an hour, and the annotation would take an hour and a half. You can run your podcast through Grok or one of those, and it will actually say, well, he actually only made 4 points. He might not say only, he's probably more polite than that. The 4 key points are this, and this, at 17 minutes and 10 seconds. And that's astonishing. And I'm sure that there are many more profound applications that will come to the fore in AI over the next 5 years. Because I'm 71, my suspicion is that as an adopter, I'll be late.
Interesting. And bringing it to, say, the daily habits and routines, I mean, I assume you have a routine at this point. I mean, what can you tell people about, say, Rick Rule's morning, and how, Rick Rule goes throughout his day as renowned investor and speculator?
That would be fairly boring.
I'm not so sure. Coffee?
Luckily enough to live in a very nice house, and unlike years where I was gainfully employed, my day usually starts with me commuting to my office, often in a robe and slippers, upstairs, which is really wonderful, I have to say. And then the new part of my career, which is doing what you do, no surprise, shirt and tie, just don't look below the waist, downstairs in my studio. So my days are much nicer than they used to be. I don't have an office to go to. Unlike at Sprott, I don't have 200 and something people reporting to me. I've done my very best to divorce myself from regulated businesses, except for starting a bank. That part's really, really, really nice. It really is nice. The fact that I don't have a commute. The fact that I don't... For a time, I lived part-time in New Zealand while I ran a business in North America. And in New Zealand, it was just my wife and I in a little farmhouse. And I sort of joked with Eric Sprott that it was in New Zealand that I learned the definition of support staff, which are those 200 people that we worked very hard to support. And not having to be directly responsible for the care and feeding of 200 families, but rather hiring people sort of ad hoc as needed is really pleasant for me.
Indeed. It kind of boils down, it's more, I guess, entrepreneurial to a certain degree in the day-to-day. You have more sovereignty over your time, would you say?
That describes it very well. Working in a big, Sprott isn't a big organization, but at Sprott, you did what the organization needed to be done, as opposed to that which was pleasant for you, and doing that which is pleasant for me, as opposed to that which needs to be done to support the sort of care and feeding of a multinational financial services firm, is very polite. If you listen to my podcasts, the fact that my political and social views don't need to take into account as much as they used to the needs and wants of government-oriented pension funds or regulators is also pleasant. I am more able to enjoy freedom of speech as a sole practitioner than I was as part of a big firm.
Okay, excellent. Are we good?
We have 5 minutes. We want time for the audience.
Okay, excellent. Does anybody have any questions for Rick?
I would like to get it going.
can I get it going, and then we'll still have time for you? I'm just so curious about the nickel sulfide piece, because that's a huge piece of the industry right now with the laterites of Indonesia. So you're looking into it, but what are you finding? What is the investment case for these great, I'm thinking like a Talon Metals, right, that has such big players behind it, but it's just been destroyed in the market. What's the case for sulfides coming back, given the new technology?
Yeah, I mean, my suspicion is that you have to have a 2-year time frame for it to bottom. I think we have at least 18 months more of increasing production of nickel laterites, unless, of course, you had a spike in energy prices, which changes things. I flew over not too long ago, southern Sulawesi, the epicenter of those laterites, and I believe that there will be a citizen backlash in Indonesia against the environmental degradation that's being caused. It has to be seen to be believed. I had read about it, but until I flew over southern Sulawesi, I hadn't understood the extent of the damage that's being caused. And my suspicion is that the laterite boom won't recede, but it'll crest. I also believe that low prices are the cure for low prices. 5 or 6 years ago, people were desperately looking for fabrication technologies that used less nickel. With the price of nickel falling by half, the pressure to look for substitutes is much less. Markets work. Low prices reduce supply, and they increase demand. But taking advantage of that takes a 5-year time frame. My suspicion is that the work that I do now on sulfide nickel will allow me to prepare the shopping list that will allow me to be active in the space a year and a half or 2 years from now. My hope is that by that time I'll know enough that I won't have to spend a year getting up to speed when the time is right to strike.
Okay, excellent. Thank you. Please.
Thank you very much. Peter Radwin from Ados Holdings. My real question is with regards to your movement into the banking sector, gold being a tier 1 asset, etc. I sort of love to understand a little more what you think are some opportunities in the banking financial sector. Gold, a party that actually understands the commodity sector and gold itself. What you're really looking to do with that, for both institutional investors and family offices such as ourselves. Thank you.
Our bank is a determinedly retail bank, not an institutional bank. That isn't to say that we wouldn't welcome institutional borrowers or depositors. But the bank that we're building today is very much an outgrowth of a bank that we built in 2020 called Everbank. We learned that you could build in the United States a big market, a community bank where community was defined by shared interests, by aspiration, as opposed to locality. And we built a bank servicing high net worth US customers that employed technology. We had no branches, which reduced our non-interest expense. There's several differences between this bank and that bank. That bank, by the way, was successfully sold and all those things happened. What we learned in the interim, and we should have known last time, but we were too stupid to notice we were growing too quickly, was there's no chartered bank in the United States that considers gold to be good collateral, which seems really profoundly odd in a market the size of the US. There is no institution that provides what are in effect margin loans for physical precious metals stored in segregated accounts. We've identified at 3 large depositories, Brinks, Loomis, and Viamat, that there's $33 billion in physical collateral in the form of precious metals in the United States alone, and nobody's lending against it. That's a community that I know well, that I talk to well. So I believe that my customer acquisition cost will be lower than my competition's, particularly because right now I have no competition. If the question goes to the composition of a bank balance sheet with regards to gold being a tier 1 asset, how do I say this politely? If you are starting a bank in the US and you're in front of the Office of the Comptroller of the Currency and the FDIC, you don't talk about exotic asset classes in the balance sheet, irrespective of the fact that they're time-honored. So I think that you will see the equity part of the Battle Bank balance sheet being very much dollar-denominated. Where you will see gold is as collateral for loans. the idea that I have collateral where I have physical possession. Let's be clear, we're not banking people who bury gold in the backyard. We want control of the collateral. But the idea that in the event of non-payment, that I can sell the collateral in 10 seconds, 24/7, as opposed to other forms of collateral that I might have, a second mortgage on a house or something. To me, I think precious metals are excellent collateral, and I think that'll be the differentiator with this bank.
So a big thank you and Happy New Year to Rick Rule and all the listeners of this podcast. Thank you for your ongoing support. I hope you have enjoyed what was a fascinating year in the natural resource sector. If you want to help out the podcast, please leave us a review in the Apple Podcast directory. Share it with your friends. And until next week, take care.